Good afternoon, and welcome to this Traders Accounting webinar. My name is John Polk, and I'll be presenting today. As you can see from that alphabet soup behind my name, I do have both my law degree as well as a Master's of Law, and that's in taxation. Both of those are from the University of Denver in Colorado, where I worked in tax controversy before coming down here to beautiful Phoenix, Arizona to work with Traders Accounting. And Traders Accounting has been around for 15 years working in this field. And we have specialized in taxes and accounting for traders that entire time. And along with our entity setup services, we do also offer bookkeeping, tax preparation, 401k consults, living trusts, and a number of other services. But we do ask that you keep a couple of things in mind as you're listening to today's presentation. The first is that tax information is changing constantly. We do make every effort to keep this presentation as up-to-date as possible. However, please consult with either a tax accountant or a tax attorney before you rely on the information contained here. The second is that Traders Accounting is not a law firm, so none of the advice given today should be considered legal advice. If you'd like to find out a little bit more about Traders Accounting, read a little bit more about the services we offer, the bookkeeping, tax preparation, etc., you can find our website at www.tradersaccounting.com. You can reach us by phone at 1-800-938-9513, by email at learn@tradersaccounting.com, and we also invite you to check out our blog, the address of which is at the bottom of the screen. We will have time for questions and answers today at the end of the presentation, and if you have any questions about anything as we move through the presentation, just type your question into that question comment box, and we'll address them at the end of the presentation. In addition, along with this webinar, we are offering a free 30-minute consultation to discuss your personal situation and how it can interact with the various entities that we can help you set up. If you'd like to take advantage of that, please go ahead and put your name and phone number in that question comment box, and Raven will call you immediately to set up that free consultation. And this quote from Judge Learned Hand really gives the philosophical basis for everything we do. And I'll give you a moment to read over it, but the highlights of it are that anyone can arrange their affairs so that their taxes shall be as low as possible. Everyone does it, and no one owes any public duty to pay any more in taxes than the law demands. And one of the things we're going to talk about today is just how to arrange your affairs so that you're paying no more in taxes than the law demands of you. So the question is, why trade with tax efficiency? And the answer is twofold. First, by trading with tax efficiency, you're going to increase your cash flow. And by increasing your cash flow, this is going to lead to more profits sooner. To give you an idea of just the kind of difference that trading in a tax-efficient environment can make, we use this little demonstration. If you take a dollar and double that dollar every year for 20 years in a tax-free environment, at the end of that 20 years, you'll have $1,048,570. And that's growing in a completely tax-free environment. On the other hand, if you take that same dollar, double it every year, and every year tax it at the current maximum rate, 42.9%, that same dollar, doubled every year for 20 years, will only leave you with $7,867 at the end of that 20-year period. And just from this, trading inside of a tax-advantaged environment, you can make over $1 million. And obviously, this is an extreme scenario, but the benefits that you can receive from trading inside of this tax-free environment can be pretty powerful for any trader. And we like to use this metaphor when we talk about trading. If you take the path on the left, it's undeveloped, and this is trading outside of a tax-advantaged environment. Trading taxed as an investor, which we'll discuss a little later on. And this path on the right, it's trading in a tax-advantaged environment. Excuse me. And trading inside this tax-advantaged environment, set up through a business entity, taxed as a business, taking advantage of all of the various business deductions that you can take advantage of, really is going to lead you to a much more tax-advantaged trading environment where you reach your goals of profit substantially sooner and with a lot less unexpected dangers along the way. And there are a couple of facts that you should keep in mind as we talk about trading. And as a trader, taxes are your largest trading expense. It's pretty self-intuitive that as you make more, you're going to be taxed more. But even in years where you're showing a loss, taxes are going to remain your largest trading expense due to something called the $3,000 capital loss limitation. And we'll get into that in much greater detail a little later on. But the second is that for every dollar you write off through a deductible business expense, a tax write-off, your cash flow is going to increase. You'll have more to trade with. And so by following a tax-efficient trading plan, you're going to maximize the amount of money that you can write off, maximize your cash flow, and really maximize your profit through trading. So how does the tax code affect traders? There are really two tax codes in this country. There's the individual and the business code. And both of these are legal and available, but you simply decide which one that you'd like to use. When we talk about a business, it's important to know just what the IRS considers a business to be. And to determine whether or not an activity is a hobby or a business, the IRS uses what's called the Economic Performance or All Events Test. And it really does exactly what the name says. It takes a look at what this business is actually economically doing and all the events surrounding it. The IRS can really look at anything it wants to when it's performing this test. However, it has used 10 specific factors in the past. But no one of these specific factors is determinative, and the IRS really can look at any other information besides these. But the factors are whether or not you're carrying on that activity in a business-like manner. Whether or not the time and effort you're putting into this activity indicate that you're intending to make it profitable. Whether you're depending on the income from this activity for your livelihood. Whether your losses in this activity are due to circumstances beyond your control or are normal in the startup phase of your business. Whether you change your methods of operation in an attempt to improve the profitability of this activity. Whether you or your advisors have the knowledge necessary to carry out the activity as a successful business. Whether you've been successful in making a profit in similar activities in the past. Whether the activity is making you a profit in some years. Whether you expect to see a future profit from the appreciation of the assets that you're using in this activity, and whether or not this activity has produced a profit in at least 3 out of the last 5 years. Again, these are just the 10 most common factors that the IRS uses when determining if you're a business. However, they can apply really any other information that they want to in making this determination. But if you do qualify as a business, there are a number of advantages that you can receive. These improvements to your tax situation bring you closer to that developed road. And these deductible expenses are all things that you can take if your trading is taxed as a business. You can receive a deduction for any fees you pay to set up this business, the organizational expenses. You can deduct furniture and equipment that you put into service in this business, and the business can take depreciation deductions based on those. The business will receive a one-time write-off of any startup costs associated with it, up to $5,000 in the current year. And if you have additional startup costs above that $5,000 limit, you can then amortize those over the next 180 months. You can also deduct expense for any mileage driven on your personal vehicle for this trading business. You can deduct expenses related to payroll to employees, including payroll taxes on the federal and state level, medical insurance, contributions to both qualified and non-qualified retirement plans, life insurance, as well as deductions for medical expense reimbursement plan. And this includes really dollar-for-dollar reimbursement of any out-of-pocket medical expenses you have personally, which your trading business can then deduct 100%. And we'll go into that one in much greater detail a little later on as well. But you can also receive deductions for dues and subscriptions you pay for your trading, for any platform and data fees, any trading magazines, news services, newsletters, newspapers, trading organizations, satellite radio. You can receive deductions for educational expenses, including home study, seminars, and trade shows. And these are any expense related to trading, so any training seminar that's related to trading techniques or anything like that, can be deducted, along with travel and hotels to that education. You can write off equipment repairs, license and permits on the state and local levels. You can write off an expense for your home office and reimburse yourself for the use of your home in that trading business. You can write off any bank service charges, office supplies, software purchases. You can write off your telephone and fax charges, your internet connection that's related to trading, your television. You can also take expenses for professional fees, accounting, tax services that you use for this business, and travel and entertainment, as well as for that education. You can also deduct travel and entertainment for any other business-related purposes, so long as you qualify as a business for these tax purposes. But the IRS does have a pretty particular stance on just how you can take these deductions. And the IRS does believe that deductions are a matter of legislative grace, and that the burden is on you as the taxpayer to keep adequate records showing the amounts of deductions or credits that you're claiming. And this is as simple as keeping good records of just how much you're paying for each of those business expenses I just listed. However, the taxpayer must also maintain records showing that you are entitled to take these deductions, credits, and expenses. So not only is the burden on you to keep the adequate records for how much the deductions are, but you need to keep adequate records showing that you are, in fact, a business and are entitled to deduct these expenses as business expenses. So let's go back a little bit and talk more about how the IRS classifies traders. And if you're an individual, you are taxed as either an investor or a trader in securities. And the investor is really the default tax status for individuals, the undeveloped path that we talked about earlier, a completely untax-advantaged environment. Whereas the trader in security is taxed as a business and a little more developed. You can also trade through business entities, and this is the C corporation, which is a completely standalone business entity and a business from the moment it's set up. Or you can also trade through what are called pass-through entities. And these pass-through entities include the limited liability corporation, which is really the best pass-through entity to use for a trading business, the subchapter S corporation, which is really the worst pass-through entity to use for any type of trading business, or the limited partnership, which is a somewhat antiquated form of pass-through entity to use for trading. However, it can still work for you if you'd like it to. But the limited liability corporation really is the best one to use for any type of trading business. And again, if you'd like to schedule that free 30-minute consultation to discuss all these tax statuses and just which one of these would be best for you personally, please put your name and phone number in that question comment box, and Raven will contact you immediately to schedule that free 30-minute consultation. But back to investors, and this is the tax environment that is completely unadvantaged. And it's the default tax status for individuals. And generally, the IRS thinks of these people as individuals who are looking for long-term appreciation and dividends from trading. But any trader who does nothing to improve their tax status is going to be regarded as an investor. This is the default tax status. And there are a number of negatives for being taxed in this way. Investors are specifically barred by the IRS from taking certain investment expenses as deductions. And these include, most importantly, any expenses related to your education for trading. So if you're being taxed as an investor, you cannot write off any expenses related to studying to become a better trader. Additionally, you can only take these business expenses, the ones that are available to investors, if you itemize on your personal tax return. And even then, they're going to be subject to the 2% AGI limitation as an miscellaneous itemizable expense. But there are some even bigger issues facing investors. And these are the $3,000 capital loss limitation that I mentioned a little earlier on, the wash sale rules, and then the tax strata rules. And all three of these are really the biggest issues facing investors. And this $3,000 capital loss limitation, again, is the biggest reason that taxes are your largest trading expense, even if you're losing on a year. And this limitation applies against capital losses. If in any year you have capital losses, you can only write those off $3,000 at a time against your ordinary income. So let's say in 2012 you had ordinary income from various sources of $100,000, and you had a terrible trading year and have a capital loss of $100,000. Because of this $3,000 capital loss limitation, you can only write off $3,000 of that $100,000 capital loss against your ordinary income. So you'll have $97,000 of taxable income in 2012 and a suspended capital loss of $97,000. You'll carry that forward into future years and be able to write it off against future income and future capital gain, but in the current year, that loss really is unavailable to you. Then there are the wash sale rules. And these wash sale rules occur when you sell a security at a loss, and within 30 days, either before or after that sale, you purchase that same security or a substantially similar one. And the tax courts have held that an option is a substantially similar security to the underlying stock or asset or really anything that it's on. So the wash sale rules really do come up more often than you would otherwise think. And when these come into effect, your loss on that initial sale is completely disallowed. Then the basis of that newly acquired stock is adjusted to take account of that loss. So you're not losing the loss entirely. However, it can cause some pretty bad consequences for you if that loss is disallowed at the wrong time. So for example, let's say you own Microsoft at $25 a share. And at the end of 2010, you go ahead and sell off your Microsoft stock when it's trading at $23 a share, taking a loss of $2 a share. After the end of the year, you go ahead and rebuy that same stock, again at $23 a share. But in this situation, the wash sale rules are going to come into effect. So your loss on that initial sale is disallowed, and the basis in that new stock is stepped up. And this may seem like it could be just a headache, an administrative one at the end of the year as far as bookkeeping, but what if that loss that was disallowed was offsetting some pretty substantial capital gains? If the loss you had tried to harvest by selling that Microsoft was $600,000, for example, and that loss was now disallowed, that's going to increase your tax liability for the year by about $200,000. And so really, you don't want to fall afoul of these wash sale rules. And they can have some pretty terrible effects for individuals taxed as investors. But the other side of the coin for individuals, being taxed as a business, the more tax-advantaged situation is being taxed as a trader in securities. And to be taxed as a trader in securities, there's no election necessary. If you qualify, if you've kept the sufficient records to show that you're entitled to be taxed as a trader in securities, you simply go ahead and file a Schedule C with your individual tax return and go ahead and deduct all of your trading business expenses on that Schedule C. And this trade in security is also known as trading as a sole proprietor. They're the same tax status. But even with these traders in securities, the more advantaged tax status for individuals, there are some pretty serious concerns. The biggest of which is that there's nothing in the tax code about what a trader in securities is. All of the information we have about what a trader in securities is comes from IRS publication 550, as well as some tax court cases. And in addition, these traders in securities or sole proprietors are audited substantially more often than either individuals or people trading through formal business entities. And as I mentioned, the IRS publication 550 gives these special rules for traders in securities. And it says that a trader in securities seeks to profit from daily market movements in the price of securities and not from dividends, interest, or capital appreciations. Traders in securities must have substantial activities in the market, and they must carry on these activities with both continuity and regularity. Unfortunately, they don't get any clearer than that. They do give a couple of facts and circumstances to consider in order to determine if you're seeking to profit from those daily market movements, if your activities are substantial, and if your activities are carried on with continuity and regularity. And these facts are the typical holding periods for the securities you buy and sell, whether you're in and out in the same day or hold them for more than a year, the frequency and dollar amounts of your trades during the year, and the amount of time that you personally are devoting to this trading activity. But that's really the clearest they get. There are no hard and fast rules on what your holding period should be to show that you're looking to profit from daily changes in market price. There's no firm rule on the number of trades you have to make or the amount of dollars you have to be trading for it to be substantial. And there's no real clear rule on just what amount of time is considered to be a continuous and regular. So
trading is a battle between you and the market.
Go to the tax court cases. And these three tax court cases are really the big three when it comes to the trader and securities tax status. And in all three of them, the taxpayers were traders and elected to be taxed with trader and securities. They filed using their Schedule C and looked to write off some trading expenses as well as make the mark-to-market election and avoid that $3,000 capital loss limitation. And in Chen v. Commissioner, which is really the first trader and securities tax status, the taxpayer there was a trader, and he had more than 300 trades in the year in question. He had made the mark-to-market election, which is an election only available to traders. That gets you out of that $3,000 capital loss limitation. And then Mr. Chen also had some pretty substantial education and expertise in trading. And based on those three reasons, he alleged that he deserved to be treated as a trader in security, taxed as a business, and really enjoy all the benefits of being taxed as a business. Unfortunately, the IRS took a look at those 300 trades and noted that they were made over the course of 3 months rather than the entire year. So the trading was not continuous. And even though Mr. Chen had tried to make the mark-to-market election, he had made it improperly, and it hadn't been effective. And again, even though he had education and expertise in trading, he had a full-time job elsewhere. And based on those three facts, the IRS went ahead and disallowed his status as a trader in securities. And because he no longer had that mark-to-market election, he lost the ability to write off $600,000 of loss in the current year, and his tax liability increased $252,000, all because he was taxed as an individual rather than as a trader in security or business. The next case we look at is Holzinger v. Commissioner. And again, in Holzinger v. Commissioner, the taxpayers in question had more than 300 trades per year. And it was a husband and wife trading together, and they had set up a special business entity, a trading LLC, to use for trading. And they also talked about the holding period of their investments, showing that they were trader in securities. Unfortunately, the IRS took a look at this and again disagreed. And even though they had more than 300 trades per year, they were trading on less than 40% of the available trading days. And based on that, it was not continuous trading. Then the IRS took a look at their trading LLC and determined that even though the Holzingers had set up this special business entity to use for trading, they did not use it. They traded in their personal accounts exclusively. Then the majority of their investments were actually held for more than 1 year, rather than the short holding periods that would have indicated they were traders in securities. And again, based off those three factors, the tax court disallowed the trader in securities tax status for the Holzingers and disallowed over $300,000 of losses. Then, in the third tax court case, K v. Commissioner, we had a taxpayer who was trading over 3 years. And over the 3 years in question, he was trading up to $20 million in total trades during the year. In addition, He alleged that his trading methods, short holding periods in and out of the market, showed that he was a trader in securities. But the tax court determined that in the 3 years in questions, he was trading less than 25% of the available time in year 1, and less than 10% of the available trading days in years 2 or 3. So despite the large dollar amount of trades he was making, they weren't substantial activities due to the fact that there was so little actual trading. In addition, the majority of his positions were open for more than 30 days. He was not seeking to profit from daily changes in market price. And based on those 3 things, they disallowed his status as trader in security and taxed him as an individual. And taxed as an individual, he could not write off over $200,000 in expenses. And so based on those things we've talked about, how can you decide whether or not it's worth it to be taxed as a trader in security? You can weigh the benefit, deducting the trading expenses, being able to write off things like education, your health expenses, things like that, against the cons, the problems with trader in securities, the uncertainty of the tax status, and just what qualifies as a trader in security, as well as the increased frequency of IRS audits against individuals filing as a trader in securities. Or you can trade in a flow-through entity or a standalone business entity. But again, these flow-through entities that you can trade through are the limited partnership, which again is a very antiquated form of entity to trade in, but okay. The subchapter S corporation, which is the worst entity to trade in. And then the limited liability corporation, which is really the flow-through entity of choice for traders. And in that LLC, the owners of that LLC are called its members. And an LLC can be managed by either one person in a manager-managed LLC or by all of the members in a member-managed LLC. The IRS does consider single-member LLCs to be completely discredited entities. So if you have a single-member LLC, you have the exact same problems as a sole proprietor or a trader in securities. So you do need to have a multiple-member LLC, at least 2. But when you're set up that way, the LLC is taxed as a partnership, and it pays no tax whatsoever at the LLC level. Any profits you make from trading through this LLC flow through to the members with no payroll tax owed and with the same characterization of income. So if your gains were capital gains inside the LLC, they will flow through to you as capital gains. Alternatively, you can trade in a standalone business entity, the C corporation. And these do pay its own taxes, but at a much smaller rate than you or I do, 15% on the first $15,000. And there are some special tax rules that apply to C corporations that allow them to be even more beneficial to traders. But one of the biggest advantages of the C corporation is that they are considered to be a complete business as soon as they're set up. But the special tax advantages that come through using a C corporation are the medical expense reimbursement plan, which I mentioned a little earlier. They are the best entity for retirement vehicles, and they're the best entity to use if you'd like to pay your family a wage. And when I mentioned the medical expense reimbursement plan, this really is one of the biggest advantages of using a C corporation. Through this plan, you can reimburse yourself 100% for any medical expenses that you pay out of pocket. This includes things like copays, deductibles, visits to the dentist, visits to the optometrist, glasses, contacts, anything like that for yourself as well as your family. You can reimburse yourself 100% in a non-taxable event to yourself, then deduct those medical expenses 100% on the C corporation's tax return. If you had taken them on your personal tax return, they'd be subject to a 10% AGI limitation. So you're receiving even more of a benefit for these deductions on the C corporation's return. Next, the C corporation is the best entity for retirement vehicles. To pay into something like a self-directed 401k plan, which is a retirement vehicle that you can sponsor through the C corporation, fund with your trading profits up to $51,000 per year, and then trade really however you like, you will need to have it set up through the C corporation and have wages paid from the C corporation out of your trading profits to contribute to that retirement plan. You can set it up through an LLC, but it is substantially easier to do so through a C corporation. And then if you are going to hire your family in that C corporation and pay them a wage, it is much easier to do so through that C corporation, whereas in the LLC, you do run into a little trouble if you're attempting to pay, for example, your child for helping out with some research or really anything like that.
My name is Darrell Jobman. As the editor of Commodities
Then you
Magazine
can
and Futures
actually
Magazine
combine
in the
both the C
1970s and
corporation and the
1980s,
limited
I was
liability
exposed to a lot
corporation,
of good trading ideas from
and
some of the most
gain really
well-known
the
traders
best
in the
benefits
trading business
possible
at
in the
that
most
time.
tax-advantaged
Of
trading
course, this was
situation.
in the era
And in this
BC, that
setup,
is,
you
before
would have
computers. It was a
the C
challenge enough
corporation,
then to
which
get
would be
accurate
the
and
management
timely and
corporation for the
reliable
business entity.
quotes and other
And the
data.
C corporation
I
would
think
handle
probably
all
the
of the
limitations
expenses
we had on
for the
technical
LLC,
analysis.
anything related to trading, that entire list of expenses that we ran through a little earlier, as well as medical expenses for yourself and contributions to retirement accounts on behalf of yourself and your family. Then the LLC will handle the money. Your brokerage account, all of your trading assets will be in that LLC, and in it, it will generate trading profits. They're going to flow out to you through that passive flow-through taxation, so you'll take the income not subject to payroll taxes. Then the income will also flow up to the C corporation, where it will be used to pay those business expenses, pay medical expenses, and make contributions to that retirement plan. And so by using both the C corporation and the LLC together, you really can maximize the tax benefits that you're receiving from setting up the business entities. So, a little recap. Why is it beneficial to trade through these business entities? First, you can deduct expenses without worrying about the special rules for traders. By operating through these entities, you are not held to the same standards as individuals who are trading on their own. And by using these entities, you can go back and write off up to 12 months of pre-incorporation expenses and bring those into your corporation or LLC to write off against future income. You can use these entities to set up a very tax-advantaged situation and increase your cash flow. And by increasing your cash flow, increase your profits. You can use these entities because of the perks that they offer you. That medical expense reimbursement plan, where you can pay 100% of your medical expenses through the corporation. The self-directed 401k, where you can really defer your trading profits into yet another tax-advantaged trading account. And the wealth protection offered by really insulating and isolating your personal assets.
Day trader or act.
By having your assets inside these corporations, you really can protect these assets against personal judgments against you, and set up several advantageous estate planning and transfer taxation situations to really protect and control your wealth. And again, if you'd like to schedule a free 30-minute consultation to discuss which one of these business entities is going to be best for you and your personal tax situation, please put your name and phone number in that question comment box, and Raven will be in touch immediately to schedule that coaching call, or excuse me, that free consultation. And one of the most common questions we get about these business entities is, how do you get going? And who you have set up these entities does make a difference. Anyone can set their own entity up. You can certainly go to LegalZoom or NOLO and create an LLC or an S Corp or C Corp in your state. But you really should make sure that your incorporator understands trading. And we here at Traders Accounting very much would like to help you and have a plan in place to set up these business entities that really ensures you set them up in the most tax-advantaged manner possible. We do also get a lot of questions about what state should I set up this business entity in. And it is generally best to set up this entity in the state where you live. There are a few exceptions to that rule where the taxes and administrative headaches of setting up in your personal state really are not worth it, and setting up somewhere like Nevada, where there's no personal income tax, really does become worthwhile. But it is based very much on which state you're in. And whether or not that would be advantageous for you is one of those questions that is best answered in that free 30-minute consultation. And now I'd like to get a little more technical about just how traders are taxed. And generally, traders are taxed as capital gain or capital loss. And this capital gain or loss is either long-term, if you held the asset for more than a year, where the maximum tax rate is 15%, or if you're in the new highest tax bracket, $450,000 or more a year, it's taxed at 20%, or the short-term capital gains rate, where you hold the asset less than a year. And that short-term tax rate is the same as your ordinary income tax rate. Also, there are hybrid contracts, otherwise known as 1256 contracts. And these are taxed at 60% long-term capital gain at that 15% rate, or 40% short-term capital gain at whatever your ordinary income rate is. And the mark-to-market election is one I mentioned earlier as one that is only available to traders in securities. And this is the one that Mr. Chen tried to make but made improperly. And improperly making this election was one of the factors used to determine that he should not be taxed as a business. But this mark-to-market election really can be a cure or a curse for your trading business depending on your personal situation. As I said, it's only available to trading businesses. But it has the effect of changing your capital gain or loss from trading to ordinary income or ordinary loss. This completely does away with that $3,000 capital loss limitation. Also, the mark-to-market election completely does away with the wash sale rules and the tax strata rules. But there are some pretty stringent rules on just when and how you elect it, as Mr. Chen discovered. And I'd like to go back to that $3,000 capital loss limitation. And again, if you have $3,000 of capital loss, or excuse me, $100,000 of capital loss, you can only write it off $3,000 against ordinary income if you're being taxed as an individual. If you're being taxed as a trading business, you can make the mark-to-market election. And that has the effect of completely writing off your trading loss against that ordinary income. So with mark-to-market election made, in that same year, instead of $97,000 of taxable income, now you're looking at $0 of taxable income and $0 of suspended loss moving forward. And that alone makes the mark-to-market election incredibly valuable for traders. But if you make the mark-to-market election, you also become completely exempt from those wash sale rules. And back to that example from before, owning Microsoft, selling at $23 a share for a loss of $2 and rebuying it on January 1st of the next year. With the mark-to-market election in place, that initial loss is completely allowed in the current year. And your new stock purchase keeps that $23 basis. Also, by making that mark-to-market election, you get out of the tax strata rule. And again, as I mentioned earlier, that applies to investors. But the tax strata rule prevents deducting a loss on the sale or disposition of one leg of a straddle position while retaining the other offsetting leg or position. And you just get that loss disallowed until you recognize gain in the offsetting leg of that position. But by making the mark-to-market election, you don't have to worry about the tax strata rule at all. There are some traders that the mark-to-market election is not generally made. And traders that work in futures and broad-based indexes, binary options, they generally do not make the mark-to-market election. And that's because these kinds of trades are considered to be 1256 contracts. And they're taxed under that 60% long-term capital gain, 40% short-term capital gain split, regardless of the holding period on those contracts. And for these, the taxes are filed on IRS Form 6781. You simply identify gain and loss for the year. You don't have to worry about each trade. And open positions on December 31st are considered to be closed for tax purposes and then reopened on January 1st. But with these, you can go back 3 years and 4 to 5 years to write off losses.
This is brought to you by the
But
Pristine Method
if you
Trading
make
Room.
the mark-to-market
Pristine
election and
was
you trade
the
these futures and
proud
broad-based indexes,
recipient of the
you will lose the
2012 Best
benefit of
Trading
that
Course Award
60% long-term,
awarded by
40%
Trader Planet
short-term
and voted
capital
on
gains
by
rate.
you.
It is possible
Today's
to
trade,
have trading accounts that are
$3,400 day trading
affected by
profit
the
in under an
mark-to-market
hour.
election
This strategy
while
was based on a
accepting
novice
others,
gap, and this
so
was
you
played
can have
on the
both
market itself as
options
represented by the
that
QQQ.
are
You could have done the
mark-to-market
SPY also
and
if you wanted
futures
to.
that are not.
The entry is based
But
on a 1-minute
you are
PSS,
required to set that up
and the
properly
date
to
was
ensure
on
that
6/25. The
there is
management was
no
simple,
commingling
and
for
the
those
award choice
accounts
about
and the elections made
3.4 to 1,
properly
all
to
happening
only apply
inside
to the
of
accounts
1
you
hour.
intend.
We'll take a look how that happened. I want to
But
remind
then
you, though, this
the
is
other
sponsored by
type of
Master
trader
Trader.
that generally does not
Best
make that
brokerage with the
mark-to-market
best
election
rates, and
are
also
Forex
great deals
traders.
with Pristine for those of you looking for a
And
brokerage.
spot or cash Forex
And
are
also
taxed under
coming up
Section
on
988.
July 13th
They
to the
are
17th,
generally
the Pristine
ordinary
proprietary trading
gain or
program.
ordinary loss.
Pristine's own trading
So they
program
never
that
have
can
to
allow
worry
you to
about the
trade
capital
firm
gains
capital
treatment to begin with.
and literally earn the right to trade up
But
to
it is
millions of
possible
dollars
to
if you
change
don't have
Forex
the
trades
equity that you need
from
to be a
ordinary
day
gain
trader.
and ordinary
This
loss
is the way
to
professionals
those
learn how to
Section
trade.
1256
Take a
trades
look at the
and
Pristine
have them
proprietary
taxed
trading
under the
program
60%
if you need
long-term,
capital
a
to be
40%
trading.
short-term capital split. However, this is not a
The
universal
QQQ,
election.
the
It
market.
does need
In
to
the
be
Pristine
made on
Method
a
Trading Room,
trade-by-trade
we don't
basis.
trade the market a
But
lot.
by
We
making it,
specialize in
you
trading
can convert
equities,
that ordinary
stocks,
income into that
that
much more
help
beneficial
to
60%,
capitalize the
40%
move based on a
split.
bias in the market. However, sometimes the market just sets up in a way that is
In
hard to
addition
resist, and we
to
occasionally will take the market. It also
setting up
goes to
these
show
entities
that the
and
Pristine Method can be
bookkeeping,
used to trade
we at
anything
Traders
that you want
Accounting
to
can
trade.
also
The
help
market
with
itself,
the
futures,
self-directed
through
401k that I
futures,
mentioned a
or
little
through
earlier in the
stocks,
presentation,
or Forex.
as well as a family
Anything
living
you want to
trust
trade can be traded
and
that trades
tax
with volume.
preparation services.
This particular
And
day,
I'd like to take
the
a couple
market
of
didn't
minutes
have
to
a
go
very huge
through
move, but we want to
the
capitalize
benefits
on that
that
move
each
down
of
in the
these
morning. And
things
the reason
can
we
bring
did
to a
was
trader.
because it was happening in the morning on the gap
And
up.
the self-directed
This is a
401k that I
particular
mentioned a
setup
little
that
earlier
occurs that often
really is a
indicates that the gap
phenomenal
will be
tool
filled. Note
for a trader.
that gaps in general do
By
not
setting
have
up
to
the
fill, but this
self-directed
particular one was
401k,
set up in a
you
way
can
there's a high
increase the amount you have to
probability
trade
that
with
it would.
by borrowing up to
We came down and
$50,000
looked, since
from
we
your
were looking to
401k
short
plan.
that rally that went into
The
resistance.
one that you
We
set
came
up
down and found
can
an
either
entry
be a
off the
Roth
1-minute
or a
chart.
regular 401k. A regular 401k is one where taxes are deferred until you take the assets out. You can trade them and make profit on any assets inside that 401k.
I've learned a
without
lot over
having
the
to pay
last
tax
21
on them.
years.
The Roth 401k, on the other hand, is one that contributions are made to on an after-tax basis. And once you put assets into a Roth 401k, you never pay tax on them. But then you can also avoid the FICA tax on contributions you make into this 401k plan. Using a regular 401k plan, you can shelter up to $51,000 per year by diverting them into that 401k plan to trade however you see fit. And using a Roth 401k plan, you can contribute up to $17,500 per year to that Roth account. These do offer some pretty outstanding asset protection, yet another layer of separation between yourself, the company, and this new 401k plan, which is entirely separate from both. In addition, with the self-directed 401k plans, you really can set them up at any age and continue to both make contributions to them and trade them however you see fit until you retire and shut down the C corporation that is sponsoring this self-directed 401k plan for yourself. And by doing this, it really allows you to take personal charge of your retirement future. There is no limit on the investments that you can make using the self-directed 401k plan. Well, that's not quite true. You are prevented from investing in collectibles, so you can't set your 401k into sports memorabilia. However, any other type of investment that you can think of, you really can make using this self-directed 401k plan. Futures, margin trades, tax lien certificates, real estates, really anything you want. And because it's a completely self-directed 401k plan, you do maintain complete control over the assets. You are trustee on the account, and no one else has control over it but yourself. And because it's a 401k plan, there's no requirement for you to begin taking required minimum distributions. So long as you continue to work inside this C Corp, you can continue to contribute into this 401k plan as long as you want. Then there's the Family Living Trust. And the Living Trust is really just a way to set up an orderly distribution of your assets, a way to make choices in advance, and really a way to protect your personal privacy. And by using this trust, using it to protect your privacy is one of the most basic and common uses of these plans. Once an asset is placed inside the trust, it is considered inside of a private document. And for example, I do know a number of individuals who own their homes through a living trust, so that you can't track down their names by looking at the property records at the recorder's office. But then you can also use them to avoid probate. And to go back to that privacy a little bit, by moving your assets through a living trust instead of through something like a will, all of your assets pass privately, whereas the wills are public documents. But then in addition to that, assets that pass through these living trusts avoid probate. And probate really is a very time-consuming and expensive process for everyone involved. I worked with a client only on the very edges years ago, where he had been married in the past and had an estate plan in place using a will, sort of traditional estate planning tools. This client had then gotten divorced from that wife and remarried. In an attempt to care for his current wife, he set up a living trust to care
Hi,
for her after
I'm
his
Dan
death.
Kramza.
Unfortunately,
Let's talk
he
about
passed
trading
away before
futures.
getting that trust
I'm
in
sure
place.
that many of you are familiar with the
His
topic,
ex-wife
but let's
challenged
start.
the widow in probate court, and as a result, the probate process stretched out to the point that the widow actually passed away herself before receiving any of her deceased husband's estate. And if he'd gotten that family living trust in place before he passed away, he really could have avoided that whole process, and his widow would have had access to his estate while she was still alive. But then really, by setting up this living trust, you can make your decisions in advance. You can set up optimum transfer taxation situations. And you can really provide for the needs of any special needs children or grandchildren you have, or provide for your own care through long-term health decisions, a living will, and advanced health care directives. But by setting up that living trust, you really do get to make your decisions early and really make them stick. And finally, this time of year, tax preparers are really on everyone's mind. And it's an unfortunate truth that there aren't a lot of preparers out there who understand the ins and outs of trading. So we suggest that you ask your tax preparer, do you understand traders' taxation? And ask them 3 questions. What is mark-to-market, and how do I elect it? And the mark-to-market election changes your capital gain and loss to ordinary income and ordinary loss, and it's elected by requesting a change of accounting method. What are the wash sale rules? If you sell a security at a loss, and then within 30 days before or after purchase that same or substantially similar security, your loss on that first sale is disallowed. And how are 1256 contracts taxed? 60% long-term capital gain, 40% short-term capital gain. Based on those 3 questions and the answers that you receive, it really should give you an idea of just how familiar your preparer is with taxes. And please remember that you can always use us here at Traders Accounting for your tax preparation needs. And again, there are really 2 paths to profit. And the path on the left is trading outside of a tax-advantaged environment, being taxed as an investor. And the path on the right is trading inside of a tax-advantaged environment, trading through a business entity, receiving the benefits of that pass-through taxation, not paying payroll taxes, making tax-free contributions to your 401k plan that you can then trade according to however you see fit. By using that tax-advantaged trading environment, you really will see profits from trading much sooner, and you run into much less unanticipated danger along the way. Thank you very much for your attention today. I very much appreciate it. There is a recording of this presentation being made, and if you'd like to receive a copy of this presentation or any of the other presentation materials, such as the slides, a copy of the expense sheets listing the total deductible expenses that you can receive by being taxed as a business, an IRA Department of Labor letter, as well as a letter with the IRS describing a business or hobby, please send us an email at learn@tradersaccounting.com and put the following items in the subject window, just letting us know which handout you'd like to receive. And again, that's presentation recording, presentation slides, and those other handouts. And again, if you'd like to schedule a free 30-minute consultation with one of our advisors to discuss your personal tax situation and which one of these entities would work best for you, please put that name and phone number in the question and comment box. And if you would like to have a little bit more information on deducting these business expenses, we do suggest the Tax Strategies for Business Professionals CD set by Sandy Botkin. It really is a phenomenal tool for learning about those deductions and how to take them. We do offer the CD set at a $140 discount through our website. You can check it out at that address. But thank you very much for attending. And at this point, we're going to open it up to questions. So I'm going to scroll back up and look at the questions that were asked throughout the presentation. And if you have any further questions, please go ahead and type them into that question comment box, and we'll work our way through. Let's see, several people have asked just what about that C corporation makes it the worst business entity for trading. And that's because in a C, or in that subchapter S corporation, you're required to take some of your profits as compensation. So you're required to pay out some of those trading profits as wages subject to payroll taxes. Whereas if you set up through that multi-member LLC, all of your trading profits flow through to you, not subject to payroll taxes. And so by trading through that LLC, you really do get to avoid payroll taxes altogether. But by trading in an S corporation, you're required to pay them. See, DK asks, is an LLC available for only one member? And as I mentioned in the presentation, a single member LLC is treated as a disregarded entity, so really subject to the same problems as a sole proprietor or trader in security. So in order to add a second member to an LLC, what you can do is set up a management trust, a completely separate business entity that exists wholly to own the other membership position in your LLC. By doing this, you can set up a multi-member LLC using just yourself and this management trust that you'll be the trustee on. See, Gary Johnson asks, is it disadvantaged from a federal tax and municipal tax perspective? And the interaction of the municipal tax rates and these federal tax rules are pretty complicated. For something like this, I would absolutely suggest calling for that 30-minute consultation where we can discuss it in much greater detail. KB asks, I want to fund other business entities and use that as investments. Which entity is the correct one to use for trading and opening an entertainment establishment? And that would vary greatly on the laws of your individual state. However, the same advantages that you receive from the C corporation as a management entity for your trading is also going to be quite similar to the advantages you've had for a C corporation being the management corporation for those other business entities. But again, on something like that, I would suggest setting up that free 30-minute consultation. Scott asks, can you deduct pre-incorporation expenses at least 12 months or up to 12 months? And the answer is 12 to 15 months is our general rule of thumb. It is possible to go back further to write off expenses. However, 12 to 15 months is about the period that the IRS is okay with as far as not questioning writing off those expenses. So when you start up a business entity, you really can bring in 12 to 15 months of pre-incorporation expenses that you've spent out related to trading. see, there are a number of excellent questions on here. I thank you very much for paying attention to this degree. And if I'm not answering your question, it's because it is a little too complex to get into in this sort of format. And if you'd like to answer them in more detail, again, please leave the name and phone number in that question comment box. Bill asks, do these considerations apply in the same fashion when trading Forex? And again, tax benefits from operating through these business entities, the deduction of expenses, as well as the pass-through taxation. And if you recall, with Forex, you actually can elect to treat them as 60% long-term, 40% short-term capital gain, rather than ordinary income or ordinary loss. Sylvia asks, if you are currently trading under an LLP and profit and loss is taxed as capital gains, are you limited to the $3,000 capital loss limit? And the answer is yes, unless you have elected mark-to-market inside that LLP. But every investor starts being subject to that $3,000 limit, and you need to elect that mark-to-market on either a personal level or through a business entity in order to receive the benefit of getting out of that $3,000 limit. And the reason that it's better to elect mark-to-market inside of an entity rather than on a personal level is that to unelect the mark-to-market method, there's no official way to do it. You need to request permission from the IRS to do it, and they tend not to give their permission. So if you've elected that mark-to-market election through a business entity, you can unelect it simply by dissolving that entity. Whereas if you've done it on the personal level, you may be stuck with the result until the IRS gives you its permission. Howard asks for a little bit more information on trading in an IRA. And trading in an IRA, at least in a self-directed IRA, is going to be very similar to trading in that self-directed 401k. However, the contribution limits on a self-directed IRA are a little bit lower on a yearly basis. Well, substantially lower, $17,500 into the 401k plus $5,500 as a catch-up contribution, and match from your corporation up to $51,000 versus $5,500 into the IRA plus $1,000 catch-up contribution. But then also, once it's into that self-directed IRA, those funds must be held by a third-party custodian, whereas in a self-directed 401k, all those assets will stay completely under your personal control. Norm asks, can I trade with a Roth IRA tax-free? Absolutely. Any assets you are trading inside of an IRA are going to grow in a tax-free environment. Again, if you'd like some more information on that tax CD, please just send an email to learn@tradersaccounting.com and put Botkin in the subject line. David asks, all of my money is currently being traded inside of IRAs. Is there anything I can do differently? Absolutely. It is possible to set up this trading business entity and create a self-directed 401k inside the business entity. Once it's there, you can roll over the assets in your current IRA into this new self-directed 401k account. Once you've done that, you can either continue trading those assets inside the self-directed 401k account, or you can take a loan up to $50,000 per year, or half the remaining balance in that 401k plan, deposit that loan amount into your trading LLC, move that into the brokerage, and trade those retirement assets inside your broker or your LLC trading account as completely normal assets. And if you'd like to talk a little bit more about how that would work, again, please leave your name and phone number to set up that 30-minute coaching call. Duncan asks, is there a recommended minimum trading asset portfolio size to go this route with the C Corp? There's not really a recommended minimum trading asset portfolio. It does vary very much from person to person, state to state, trading style to trading style, and just what it is you're trading. Really setting up with the C Corporation versus the LLC matters more based on your expenses rather than your income or the amounts under management. And to understand a little bit better how that's going to work for you personally, I would suggest calling for that 30-minute consultation. Andrew asks, can trader status be claimed in the middle of the year? It absolutely can be. To claim trader status, again, as an individual, you would just report that on your Schedule C, or to really be taxed as a business through one of these formal business entities, you can create the business entity at whatever point during the year you like and begin receiving those benefits as being taxed as a business immediately. See, Howard asks, how do I effectively get my personal funds, IRA, and 401k into an LLC? Again, by setting up a LLC and corporation with a self-directed 401k, rolling over your current retirement assets into the new self-directed 401k plan, and then either trading them there or taking out a loan and putting it back into the LLC as trading funds. Again, if you'd like to talk about that retirement plan rollover into a new 401k plan and trading LLC and corporation, please put your name and phone number in that question comment box. Sarah asks, what constitute payroll taxes? And the payroll taxes are the Medicare, Medicaid, Social Security taxes that you pay. On your W-2, they are really everything that's withheld besides your federal income taxes. And so by taking income only as capital gain or capital loss, or taking income as that flow-through taxation, you will only be taxed on them at that tax rate. You won't have to pay the additional, really 30% that accounts for payroll taxes. Eric asks about Texas not paying income taxes. Absolutely. By setting up in Texas, you won't have to worry about paying income taxes on that income at the state level. However, it does work best if you're living in Texas. If you reside outside of Texas, again, the administrative burdens can really outweigh the benefits you receive from setting up in that foreign state. Brian asks, in the combination entity structure, where you manage the LLC assets from a C Corp, how do investment gains and losses get transferred into the C Corp or not at all? And the answer is twofold. There are really two paths that your trading profits are going to take to flow from the LLC account into the C Corporation. The first is through just a partner's distributive share of profits. The C Corporation is a member of that LLC and is entitled to receive a share of its profits as a profit distribution. But also, the LLC can set a rate at which it's going to pay the C Corporation for its management services. And by setting that up, that really provides a second avenue for trading profits to flow into the C Corp, for the C Corp to then use to pay LLC expenses as well as personal medical expenses. Selva asks about that Sandy Botkin CD set. It does apply to all small businesses. We do find it very useful for these trading businesses because it covers all of the expenses that you can deduct as a small business, but the expenses that it goes through really do affect all small businesses. Brendolf asks, can the LLC have passive members? Absolutely. The LLC can have as many passive members or active members as you like. David asks, can a husband and wife create an LLC? Absolutely. Under the IRS tax rules, a husband and wife can be the two members of an LLC that lead it to be taxed as a partnership and give it that advantageous flow-through taxation. Buzz asks, what specifically is a management trust with yourself as trustee? And again, that management trust serves as the second member of a multi-member LLC when you need just sort of another body to fill that spot. And the management trust will be an irrevocable trust. You will be sort of the creator of that trust as well as the trustee of the trust, the person who determines just what that trust is doing. And now the management trust that you set up for this purpose is not going to have any effect as far as asset protection, but what it does do is serve as that second member for your LLC so that you receive the benefit of the flow-through taxation. And again, if you'd like to sign up for that free 30-minute consultation, simply put your name and phone number in that question comment box, and Raven will give you a call to set up that consultation. Eric asks, do I need to start these corporation combos at the beginning of the year? No, there's no requirement to begin them at the beginning of the year. You can set them up really whenever you like. However, I would suggest sort of doing it sooner rather than later, simply so that you can begin receiving the benefits from setting up these corporations as soon as possible. John asks, how long do you have to decide whether or not to select mark-to-market after setting up your corporation? And this is an election that can be made either immediately when you set up the corporation, or if you'd like to make it in the future, you can elect mark-to-market up to the last unextended day to file your taxes for the previous year. So if you have a pre-existing business and would like to elect mark-to-market for 2013, the last day to do it would be April 15th of 2013, the last unextended day to file your taxes for the previous year. Ben asks, can you set up the C Corporation after the LLC is operational and still get the advantages of setting up the C Corporation? Absolutely. It is possible to set up the LLC first and then add on the C Corporation later. And if that's the situation that would work best for you, that would definitely be something that we can discuss during that free 30-minute consultation. See, Jay asks, my husband and I are both listed as members of an LLC. My husband does not trade. Will the IRS consider any income he makes against my taxpayer status? No. In that situation with the multi-member LLC, your husband not trading would not count against you as far as really getting those tax benefits of trading through that LLC. Again, I'm getting a lot of questions about that tax strategy CD set. I'll leave that up for a couple more minutes. Dan asks, can you have long-term gain in a separate account and one account for short-term trading business? Absolutely. And it is very possible to set up your long-term trading, sort of your investor positions as an individual, while having your trading positions, your trading accounts, in that trading business. And by doing that, it will allow you to receive the benefits from both. see. And thank you very much. I do really appreciate all the questions. At this point, I believe I've answered all the questions I can in this format. But again, I really do appreciate the excellent questions. And again, if you'd like to receive that free 30-minute consultation, please put your name and phone number in that question comment box, and Raven will be in touch to schedule that call. And if you'd like a recording of the presentation as well as materials, please send an email to learn@tradersaccounting.com and just let us know which of the materials you'd like to receive. And past that, just again, thank you very much, and I hope you have a wonderful day.